When the economy is in trouble, you will always hear investors and economists talk about the yield curve. This is because an inverted yield curve has been an accurate and reliable indicator of recessions dating back to World War II. But just last week, after almost 2 years of inversion, the yield curve disinverted, prompting many to celebrate under the assumption that a recession had somehow been avoided. But before you pop the champagne, it's important to understand that a disinversion doesn't represent a recession avoided. In fact, if we look at history, a disinversion actually represents that a recession is imminent and about to get a whole lot worse. And today, we'll prove why. And do not skip this first foundational part, as it is crucial to understand how yields work before we dig into this chart together. Think of the yield curve as a line that represents what the yield is, or how much you stand to make from different types of treasury bonds. Treasury bonds being loans that you give the government that they then pay you interest on. When we're talking about the yield curve, you can compare all types of bonds, but most of the time, we're talking about the 10-year treasury and the 2-year treasury, the long-term and the short-term. Now, in a healthy economy, you can expect that the long-term bonds are going to yield more because you would expect to be paid more the longer that your funds are tied up. When investors are confident in the market, they take their funds out of safe long-term bonds and instead invest them in something riskier like stocks. This creates a low demand for long-term bonds, which actually makes the yield go up and creates this normal yield curve. A key piece of information here before we get into what's happening today is that a bond's price and its yield have an inverse relationship. Now, this is where a lot of people get lost because it's contrary to what we know in most other situations. But as demand for a bond goes down, the yield, or what you're making off of that bond, actually goes up. As demand for a bond goes up, the yield, or what you're making from that bond, actually goes down. This is because interest rates on a bond, once issued, stay the same. So if you have a price down here and demand goes up and price for the bond increases, the amount that you're actually earning relative to the price that was paid shrinks. And a big factor of this demand is rates.
If we have to raise interest rates more over time, we will.
So we have a situation where the Federal Reserve raised rates in 2022, and suddenly any short-term bonds have a higher interest rate, therefore they are paying more than long-term bonds that were already issued. And this exact scenario that I just described that the Fed has created is exactly what has put our banks in such a pickle. So when I talk about unrealized losses that banks have, I'm referring to long-term bonds. Following 2020 and the injection of funds into our system, we had this situation where banks suddenly had an abundance of cash and nowhere to put it. So what did they do? They thought, well, we're just going to store it in a safe bet. We're going to put it all in these long-term treasury bonds. But then what happened? Well, 2 years later, the Fed turned around and raised rates. Now suddenly, no one's interested in those long-term bonds. No, instead, the short-term bonds are more favorable because they're paying more, which leaves banks in a situation where they are stuck with all of these assets, that if they tried to sell them, they actually would have to sell them at a loss. This plays a huge role into the bank's inability to have enough liquidity in order to make their depositors whole should anything happen. But enough about all of that. I just think it is so crucial that everyone understands these concepts because, to be frank, they don't teach them and they don't want people to know, because the more people that know, the more questions that are asked and the more concerns that are raised about our economy. So anyway, let's bring it back to the 10-year and the 2-year treasury yields and what is happening today. Here we are looking at a zoomed out picture of the yield curve going back to 1975. And on this chart, what we can see is that every time there's a recession, those gray bars there preceding it was an inverted yield curve. An inversion being any time this line dips below zero. So we can see here 1980, 1992, 2001, 2008, and 2020 all had an inverted yield curve prior to the recession occurring. That's why people again say that it is an accurate indicator of a recession. Now, what's happening for current day, if we go ahead and zoom in here, is that we are seeing that we just eked out of this inverted yield curve. Suddenly we are right side up again. And because of that, people online are claiming that we escaped a recession. But the truth is that if we look more closely, when we uninvert, when we disinvert, that is when we need to be the most concerned. Starting with 2001, we can see right here, suddenly the yield curve disinverts and boom, what happened shortly after? Recession hits. If we move over and we go to 2008, we can see the exact same thing. There's an inversion, we climb out of it, boom, a recession hits. Now, if we look at present day, we can see this inverted yield curve, suddenly we're climbing out of it. What is going to happen next? Boom, recession. But that's not all. If we zoom out, there's a lot more that we can see here, especially as it pertains to the time from when the initial inversion occurred to the recession. And I'll show why. So here in 2001, when the yield curve first inverted to when the recession technically started, it was a 12-month period of time. In 2008, from when the yield curve first inverted to when the recession hit, the steepening occurred, it was 27 months. So a much longer period of time, which led to more pain. Now, if we look at present day, can you guess how long it's been since the initial inversion? That's right, you might have guessed it, 27 months. There's that number again, 27 months. And we are just starting to climb out of it. So I have a feeling that we still have some steepening to go. Essentially, what's going on right now is that the Federal Reserve is in a position where they are going to be forced to cut rates. This provides optimism, hope. Suddenly, people feel as though there's a soft landing. The yield curve corrects itself. We are out of an inversion, but this steepening is just a climb of false hope. Because again, we can see, if we look at history, if we go all the way back, if we zoom all the way out on this chart, every single time that there was an inversion, it was actually during the steepening phase when things returned to normal, when the true pain happened. Unfortunately, none of this surprises me. I doubt it surprises you either. What we can see from this, though, is that history is repeating itself. We can look at history and see exactly what happened in the past and that it is happening again, which is why I think we both know that time is running out. Things are moving quickly. We are moving forward in this cycle, which is why, again, I encourage you, if you haven't already, to make sure you have a strategy in place. And if you don't know how to start one, or you're not confident in the one you have, or you just want a second opinion, even if you feel great about the strategy you have, we are here to help. Talk to one of our expert analysts at no cost to you. They are trained, they are dedicated, and they are here to help, as are we all. And again, I appreciate you being here. If someone would benefit from learning this, because again, I think knowledge is key, please share this video with them. It helps us, it helps get the word out, it helps all of us together. As always, I'm Taylor Kenny with ITM Trading, your trusted source for all things gold, silver, and lifelong wealth protection. Until next time.